Preparing for Energa FP&A Analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to join Energa as an FP&A analyst. I am a finance professional who enjoys turning operational information into clear decisions. My experience includes budgeting, variance analysis, management reporting, and building Excel models that improve visibility. Energa interests me because its results depend on complex drivers such as electricity demand, regulated activities, generation, distribution, and investment spending. I would bring analytical discipline, curiosity, and strong stakeholder communication, while learning the company's operating model and helping managers understand performance, risks, and required actions. While answering, connect your financial analysis experience, Excel or BI capabilities, interest in the energy sector, and motivation to support budgeting, forecasting, performance management, and business decisions at Energa. Question 2. What does FP&A contribute to a company like Energa? FP&A connects strategy with financial execution. At Energa, that means converting assumptions about demand, tariffs, power prices, weather, network investment, operating costs, and financing into budgets and forecasts. The team then compares actual performance with expectations, explains the drivers, and helps management decide where to act. I see FP&A as more than reporting historical numbers. It creates forward-looking insight, challenges assumptions constructively, and ensures resources support the company's strategic priorities. Make sure to cover planning, forecasting, performance interpretation, decision support, business partnering, cash awareness, capital allocation, and translating operational energy sector drivers into financial outcomes. Question 3. How would you build an annual budget for an energy business? I would begin with the planning timetable, prior year actuals, strategic targets, and agreed assumptions. I would collect bottom-up plans from business units, including volumes, prices, headcount, maintenance, procurement, capital expenditure, and financing needs. Then I would challenge the inputs against historical trends and external drivers, consolidate them, and reconcile the income statement, balance sheet, and cash flow. After scenario reviews with management, I would document ownership and establish monthly tracking against the approved budget. In your answer, talk about the planning calendar, bottom-up inputs, top-down targets, operational drivers, scenario assumptions, review cycles, consolidation, challenge, and final approval with clear accountability. Question 4. How do you approach monthly variance analysis? I start by identifying material variances across revenue, operating costs, capital expenditure, and cash flow. I separate timing effects, accounting reclassifications, one-off items, and genuine operational changes. For revenue, I would examine volume, price, customer mix, and market factors. For costs, I would investigate rates, consumption, staffing, procurement, and timing. I then validate explanations with business owners, quantify the full-year impact, and present concise actions rather than simply describing what happened. Be sure to mention materiality, actual versus budget and forecast comparisons, price-volume mix analysis, timing, one-offs, controllability, root causes, management implications, and recommended corrective actions. Question 5. What is the difference between a budget, forecast, and business plan? A budget is the formally approved financial baseline for a defined period and supports accountability. A forecast is an updated view of the likely outcome based on current information, so it should change when assumptions change. A business plan is broader and longer term, linking strategic objectives with financial capacity, investments, and operating priorities. In practice, I would use the business plan to shape the budget and the forecast to keep management informed about the latest trajectory. Focus on each tool's purpose, time horizon, update frequency, level of commitment, strategic versus operational role, and how FP&A uses them together rather than treating them as interchangeable. Question 6. Which KPIs would you monitor for Energa? I would tailor KPIs to each business area, but the core set would include revenue, EBITDA, operating cash flow, capital expenditure, free cash flow, net debt, and forecast accuracy. For distribution, I would also monitor energy delivered, technical losses, connection activity, reliability indicators, and regulatory performance. For generation or sales, volumes, realized prices, margins, customer churn, and cost to serve matter. The important point is linking every KPI to a financial outcome or management decision. In your answer, discuss financially relevant operational indicators such as revenue, EBITDA, regulated distribution performance, energy volumes, losses, reliability, CapEx delivery, cash flow, leverage, and customer metrics. Question 7. How would you forecast revenue for an electricity distribution business? I would build revenue from operational drivers rather than applying a simple growth rate. The model could include customer numbers, consumption by segment, regulated tariffs, connection activity, network volumes, and approved regulatory assumptions. I would analyze seasonality and weather effects, reconcile historical price volume movements, and incorporate management's latest commercial information. Finally, I would run sensitivities for demand, tariff timing, and customer mix, then document assumptions so actual results can be explained consistently. Make sure to cover customer numbers, consumption volumes, tariff assumptions, regulated revenue mechanisms, seasonality, weather, connection growth, losses, historical patterns, and sensitivity analysis. Question 8. How would changing electricity prices affect Energa's forecast? The effect depends on where Energa is exposed and how prices flow through contracts or regulated tariffs. Higher wholesale prices may increase procurement costs immediately, while customer pricing or regulatory recovery could lag. Generation activities may benefit, whereas supply margins could compress if pass-through is incomplete. I would map price exposure by segment, review hedging and contract terms, model timing and volume effects, and present base, upside, and downside cases with cash flow implications. Discuss exposure by business segment, pass-through mechanisms, timing differences, hedging or procurement effects, margin sensitivity, customer tariffs, working capital, and the need to model multiple scenarios. Question 9. What is rolling forecasting, and when would you use it? A rolling forecast continuously extends the planning horizon, for example maintaining 12 or 18 forward months after each monthly close. I would use it at Energa because demand, commodity prices, regulation, weather, and investment timing can change materially during the year. The process should focus on major business drivers, not unnecessary detail, and include clear ownership and review dates. It complements the annual budget by showing the latest expected outcome and emerging risks. Cover continuous updating, a fixed forward horizon, improved responsiveness, driver-based assumptions, reduced reliance on annual budgets, governance, and how rolling forecasts support volatile energy market conditions. Question 10. How would you build a forecast model in Excel? I would structure the workbook into inputs, historical actuals, calculations, outputs, and checks. Assumptions would be clearly labeled and separated from formulas, with drivers such as volumes, prices, headcount, costs, CapEx, and payment timing. I would use consistent formulas, error checks, sensitivity toggles, and reconciliation to the general ledger or reporting system. Before sharing, I would test unusual cases, review formulas independently, document key logic, and make the outputs easy for managers to interpret. Be sure to mention clean inputs, historical data, driver-based formulas, separate assumptions and outputs, checks, scenario controls, version management, documentation, and model usability for non-finance stakeholders. Question 11. How do the three financial statements connect in an FP&A model? The income statement shows profitability, while the balance sheet captures the resources and obligations created by operations. Net income flows into retained earnings. CapEx increases fixed assets and later creates depreciation. Working capital movements affect operating cash flow, and borrowing or repayment changes debt and cash. I would ensure ending cash on the cash flow statement reconciles to the balance sheet and investigate any imbalance through structured checks. This integrated view is essential for assessing both earnings and liquidity. Explain how the income statement drives retained earnings. Working capital links the balance sheet and cash flow. CapEx creates assets. Depreciation affects profit, and financing reconciles ending cash and debt. Question 12. How would you analyze a capital expenditure project at Energa? I would first clarify the project's purpose, such as reliability, regulatory compliance, capacity expansion, efficiency, or renewable development. Then I would model investment timing, operating savings or revenues, depreciation, taxes, working capital, funding, and terminal assumptions. I would calculate NPV, IRR, and payback, but also test construction delays, cost overruns, volume changes, and price scenarios. After approval, I would compare actual spend, milestones, and benefits with the business case to identify lessons. In your answer, cover strategic rationale, project cost, timing, operating benefits, regulatory requirements, NPV, IRR, payback, sensitivities, execution risk, funding, and post-investment performance tracking. Question 13. What would you do if a business manager submitted an unrealistic forecast? I would avoid rejecting the forecast immediately. I would ask the manager to explain the operational assumptions, compare them with recent trends and external evidence, and identify what must happen for the outlook to be achieved. If uncertainty remained, I would present a base case alongside management's upside case, quantify the gap, and agree monitoring indicators. If the difference materially affected group decisions, I would escalate transparently with facts, while keeping the discussion collaborative and solution-focused. Focus on respectful challenge, evidence-based questioning, operational drivers, historical performance, incentives, scenario ranges, escalation, and preserving the relationship while protecting forecast credibility. Question 14. How do you ensure data quality in management reporting? I begin by confirming the source, definition, period, and owner for every important metric. I reconcile reported figures to the general ledger or approved operational systems, check completeness, investigate unusual movements, and validate changes against prior versions. Automated checks can flag missing data, duplicate records, or unexpected variances, but judgment remains necessary. I also retain assumptions and review evidence so results are reproducible. Reliable reporting depends on disciplined processes, not just polished presentation. Mention source system controls, reconciliations, completeness, consistent definitions, variance checks, version control, audit trails, review procedures, and prompt resolution of data ownership issues. Question 15. Describe a time you improved a reporting or forecasting process. In a previous role, monthly reporting required several manual spreadsheet consolidations and often produced inconsistent commentary. I mapped the process, standardized business unit templates, added validation checks, and created a driver-based summary dashboard. I worked with stakeholders to agree definitions and deadlines, then documented the process and trained users. Reporting time fell by approximately 30%, while discussions became more focused on causes and actions. The experience taught me that process improvement requires both technical design and user adoption. Use a clear situation action result structure, quantify time or quality improvements, explain stakeholder involvement, mention controls, and show how the change created recurring value rather than a one-time fix. Question 16. How would you explain a complex financial result to a non-finance manager? I would start with the business conclusion, not the accounting detail. For example, I might explain that EBITDA is below plan because lower distribution volume and higher maintenance costs outweighed tariff benefits. I would quantify each driver, distinguish temporary from structural effects, and show the expected full-year impact. A simple bridge or chart often helps. I would then discuss controllable actions, risks, and ownership, and confirm that the manager agrees with both the explanation and next steps. Be sure to mention starting with the business question, using plain language, focusing on drivers and implications, avoiding unnecessary accounting terminology, using visuals, confirming understanding, and recommending action. Question 17. How would you prepare management commentary for monthly results? I would structure commentary around 3 questions. What happened, why did it happen, and what does it mean next? I would lead with the material result, compare actuals with budget and prior year, and use a bridge to explain volume, price, mix, timing, and cost drivers. I would separate recurring trends from one-offs, quantify forecast implications, and highlight actions and risks. Before circulation, I would reconcile every number and align wording with business owners. Discuss concise messaging, headline performance, budget and prior year comparisons, driver bridges, outlook, risks, actions, consistency with reported numbers, and tailoring detail to the audience. Question 18. What is working capital, and why is it important for Energa? Working capital is the short-term investment required to run the business, mainly receivables, inventory, and payables. For Energa, billing cycles, customer collections, procurement timing, collateral, and seasonal energy activity can create meaningful cash swings even when reported profit is stable. I would monitor overdue receivables, collection rates, payment terms, inventory days, and forecast cash movements. The objective is not simply delaying payments. It is improving liquidity without damaging supplier relationships or service quality. Cover receivables, payables, inventory, billing and collection timing, supplier terms, cash conversion, liquidity, seasonal effects, customer behavior, and the trade-off between cash optimization and operational service. Question 19. How would you assess forecast accuracy and improve it? I would compare each forecast version with actual results and measure both absolute error and bias, because consistently overestimating or underestimating performance signals a systematic issue. I would decompose errors by revenue, costs, CapEx, timing, and business unit, then identify whether assumptions, data, or execution caused the gap. Improvements might include driver-based models, better input deadlines, scenario ranges, and more frequent updates. I would share lessons constructively so accuracy improves without encouraging unnecessary conservatism. Mention comparing forecasts with actuals, measuring bias and absolute error, decomposing errors by driver and business unit, reviewing timing assumptions, updating methods, and communicating lessons without creating blame. Question 20. How would you prioritize competing requests from senior stakeholders during a tight reporting deadline? I would rank requests by decision impact, regulatory or board deadlines, materiality, and dependency on other work. I would clarify the required output and agree realistic timing rather than silently accepting everything. For urgent needs, I could provide a concise, validated view first, followed by deeper analysis. I would communicate trade-offs early, protect essential quality checks, and escalate genuine conflicts with options. Reliable prioritization means enabling important decisions quickly without compromising data integrity or stakeholder trust. Focus on decision impact, deadline criticality, materiality, dependencies, communication, minimum viable analysis, escalation, quality controls, and maintaining trust when not every request can be completed immediately. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.